Good morning. My name is Kurt Peavy. I am with Arthur J. Gallagher, and we are the consultants over the 401k plan with Selden Investments. And today, the meeting is really just to do an education series on retirement plan basics and making sure that you guys understand the importance of saving for retirement and how saving through the Selden 401k plan can help you guys reach that goal. So what I find works the best, especially at least in the virtual environment, is I'm going to run through the presentation. And then if you guys have questions, let's ask them at the end. It can be a little disruptive, especially through Zoom with my computer if I were to stop sharing my screen, as you guys can already tell, and then getting back into it. But I'll make sure that we save plenty of time for any questions that you guys have after the presentation. So really, the gist of this presentation is, if you're not already getting started in your 401k plan, developing your retirement saving strategy, what you should consider when it comes to your investments, and then maintaining your retirement strategy on an ongoing basis. Now, this slide can be, depending upon which stage in life you're at, can be very exciting or maybe a little bit depressing. But this looks at it as somebody entering their career at the age of 22. And at the age of 22, assuming that you are going to retire at the age of 65, you will have 1,118 paychecks to defer out of and save into some form of retirement plan, whether it be a company-sponsored 401k like that's offered through Selden, or an IRA that you're open up on your own. At age 35, you only have 780 paychecks left to receive and defer from. At age 45, you only have 520, age 55, 260, and then at age 65, hypothetically, if you're no longer working, then you're not receiving any more income. One of the reasons why it's so important, the earlier you start saving, the less you have to save and have to try to make up as you get older and later in your career. Now, when it comes to retirement, I know people think 105, probably not going to live that long. This is looking at if you retire at the age of 65 and you were to hypothetically live to be 105, and I'll jokingly say that I turned 50 in 3 weeks. My last living grandparent passed away last year at the age of 99. She was born in the early 1900s, and she, despite all odds, lived to be a healthy 99 years old. Under this scenario, she almost would have met that goal of 1,140 paychecks needed to support herself up until she passed away. So as modern medicine becomes more advanced, living to be 85, 90, 100 is becoming a lot more of a reality for a lot of people. Now, when it comes to your retirement plan, there's really three things. One you can control, one you have partial control, and one that's out of your control. So when it comes to saving for retirement, the two things you can control: how much you make, how much you save versus how much you spend. Now, really how much you make is more of a sum control, but how much you earn determines how much you spend, but also how much you save is determined by how much you spend and have money left over. Also, what a big equation when it comes to how much money you'll have at retirement is the asset allocation, or how you have your money invested. Those are two things that absolutely you have full control of for the most part. Now, I fully understand that there are a lot of equations when it comes to spending that are out of our hands. There are a lot of situations in life that are unexpected, but this is just more of a general hypothetical, if you will. What you do have some control over is your employment earnings. You do have the ability, within most companies to ask for pay raises if you feel that the compensation receiving is not substantial to what you're contributing. Obviously, people have the free ability to go to work for other companies. So that is within your control. And also somewhat longevity. A lot of that is predetermined by genetics, but also how you live your life also has some determination on how long you will live. But the two things that are absolutely out of your control is what is the market going to return in any one given year, and then any policies regarding taxes and how retirement savings accounts are affected. That really is completely at the control of the federal government, and market returns are really at the control of institutional investors, mutual fund companies and such. But also, I say it's out of your control, but you do have the control if you think the market is overvalued to sell out. If you think the market is, say, if you think back to 2022 when the market was down 30%, you may have thought, hey, I think the market's down pretty substantially. You have the ability to go into the stock market if you have money in the 401k plan. And I'll get into that a little bit greater detail as we go forward. Now, when it comes to retirement plan considerations, not everybody is the same. And I'll even jokingly say that even if I had a twin brother, our financial situations would not be the same. I don't have children. I don't have a pension plan. I do have Social Security. But just to state that everybody, even if you're the exact same age, we all have different backgrounds. You may have student loan debt. You may not. You may have inherited money from a relative. You may have not. You may have a small trust fund from your parents, if you're lucky. I personally do not. But all those things make up what should be taken into consideration when you're thinking about how am I going to get myself to a comfortable retirement. Now, some people still have the legacy pension plans where if you work a certain number of years, you're guaranteed a certain amount of money for life. Now, also, that most Americans do have Social Security. You hear a lot of talk on the news sometimes that Social Security is going bankrupt, and that's, in my professional opinion of doing this for almost 30 years, it's a little bit of a scare tactic. As it is now, if there's no changes to Social Security, it will start paying out more than it receives in about 10 to 15 years, but it's still going to be taking in money. The federal government is in debt to Social Security by several $1 trillion. And if Social Security cut benefit payments to future payees into the Social Security program, and that is to say, I'm about to turn 50, I will become eligible for Social Security when I'm 65. So I have 15 more years until I'm fully eligible for Social Security benefits. If they were to cut my future benefits by 10% and say starting tomorrow, anybody who's not currently receiving Social Security, if they were to cut those future benefits for all of us about to receive it, it would be solvent for at least about another 50 to 100 years. So it's not going to go bankrupt. There's very little chance, unless the federal government does something drastic, that if you have been paying into Social Security, you won't receive Social Security. You also have, if you have purchased a home over the years, a lot of people, when they retire, they like to downsize. So the sale of your home. There's also reverse mortgages where the mortgage company pays you back over the set course of a period of time. And then once that ends, the bank or credit union then owns your house. Not personally a fan of that, because if you outlive that, then you're basically out of your house, but that's just my own personal preference. And then for some people, if you have kids, maybe you put your kids through college, maybe your kids are successful, then your children may also be a source of income to help you out within your retirement. Now, Social Security as it stands right now, with no changes to it, you should expect to receive 40% of your pre-retirement income. So just say hypothetically, if you make $50,000, you should expect to receive about $20,000 per year in Social Security benefits. The rest of it you have to make up on your own. Now, I don't like to use scare tactics mostly, but if you think about it right now, if you were to take a 60% cut in your income, how would you survive? If you take into consideration, if you have a home, if you have rent on an apartment, if you have a car note, you have car insurance, you may have homeowners insurance, renters insurance, healthcare, food, electricity, internet, all those things. What would you be willing to cut back to only live on 40% of what you're earning right now? For almost everybody, that's going to be extremely difficult. I couldn't do it. Most people couldn't do it. And that's one of the main reasons why it's so important for you to save for your own retirement. And by doing so through a company-sponsored 401k plan like Selden, which does offer a safe harbor match, it helps you get to that goal of not having to live just off Social Security, and you actually have the ability to live a comfortable lifestyle in retirement. Now, how much should you save in your plan for retirement? The target, and this, take into consideration, this is a combination of both the money you put in and the amount that Selden matches. So target should be 10% if you're starting out in your career, 20% if you're later in your career. Now, with Selden, it's a 3.5% match. So if you were to contribute 7%, you would get a 3.5% match. That would put you at 10.5%, which is exactly where you need to be if you're early in your career. I'm also very realistic. I've been doing this a very long time. I know that especially if you're 22, 23, 24, contributing 7% of your income is going to be very difficult. What I tell people, if you start early, if you start small, even if you do 3%, even if you do 4%, on the Fidelity website, they have a tool that will allow you to what's called auto-escalate your deferral percentages. So if you start at, say, 4% because you want to get the company match, and then next year, it'll automatically go up by 1% to 5%. Then the next year, 5% to 6%. You can do it where there is a cap. So you want to start at 4%, and then in 6 years, you want it to stop at 10%. You can do that, or you can kind of let it just go until you don't want to contribute anymore, or you hit the maximum amount allowed to contribute by IRS regulations. Also, using the Fidelity website. Fidelity is, in my opinion, I've never worked for Fidelity. I'm not paid by Fidelity, but they have the single best website out there for participants. It allows you to do a lot of modeling. It allows you to get recommendations on your investments, et cetera. If you haven't been to their website, I highly suggest you go out and take a look at it. There's a lot of tools available to you at zero cost. Now, one of the reasons why it's so important to start investing early, it's what's called the rule of 72T. And if you've heard of compounding interest, if you think about it this way, say, for instance, you contribute $100 and it doubles, that's $200, right? Pretty simple math. If that doubles again, it's not just another $100, it goes from 200 to 400, doubles again, 400 to 800. Now, if you think about you're contributing every paycheck into the 401k plan, Selden's giving a company match. What the rule of 72T states is you take 72 divided by whatever you think interest rate you're going to earn. Under this example, 8% is, or historically has been, the average rate of return for the stock market. Over the past 10 years, it's definitely been closer to 10 to 11%. But at 8% rate of return, you will double your account every 9 years. So if you think about the fact that you may have, in some cases, 40 years to retire, you could double your account value multiple years. In the very early stages, it's not going to seem like a lot. I can promise you, I used to get very, not to say discouraged, because it didn't seem like my account was growing that much. But once you get, and I've been saving since I was about 27 in a company 401k plan. So once you get to, say, $100,000, it starts to escalate really quickly. It may take a while to get there, but once it does, the compounding interest, the account just keeps growing with your contributions, with the company match. It just seems like it's growing faster because it is. The more you have, the more it can earn. And then it just grows the balance you have in your 401k plan. And it starts to grow really fast in a normal market year when the market's not down. So that's what's going to get you to a comfortable retirement, is that beautiful miracle of compounding interest. Now, what I've stated before, the earlier you save, the more difference it makes. And this is so true. So under this scenario, you have Harry, he's 45 years old, has never contributed to a 401k plan. He starts saving $300 a month. Now, total contributions over 20 years, $72,000. He has earned, with compounding interest over those 20 years, $171,798. Not bad, right? He earned about $100,000 over that 20 years. Now, on the opposite, and this is much more closer to my scenario, Megan started saving $100 a month at the age of 25. Now, granted, Megan, even though she only saved $100 a month, she saved $152,382. So roughly double what Harry put in. But the difference is she has $324,180 at retirement. She has saved so much more money than Harry because compounding interest, she contributed less than Harry, but she has earned over twice what Harry has. So from that scenario, the earlier you start, the more you're going to have. You don't have to worry about piling on a lot of money at the end. Even though it will make a difference, it doesn't make nearly as much of a difference as if you had started saving where you're earlier in your career, because that compounding interest makes a huge difference. Now, one of the things to consider, and when it comes to saving money, you do have a lot of options out there. You have banks. You can open a brokerage account through, say, Fidelity or Charles Schwab, who owns E-Trade. But what makes it easy to contribute through your company-sponsored retirement plan? Whereas if you open an IRA, you wait to get paid, that money goes into your bank account, you pay your bills, you have your living expenses, and then generally what's left over, you're going to contribute to your IRA. It's a lot harder to contribute to a retirement plan when you're physically writing a check or doing an online transfer. Now, when it comes to the Selden 401k plan, it's a lot easier. The money comes out before you get it, right? It makes it a lot easier to contribute because it's not going to your bank account. You're not expecting it in there, and it's automatically withheld from your pay. And we'll talk about the two different ways that you can withhold pre-tax and Roth here coming up. But what's best about saving in a 401k plan is even if you leave Selden, you have the money, you have a choice to do whatever you want with your money. If it's more than a certain amount, which is $7,000, you can leave it in the Selden's 401k plan. Regardless, you still have the ability, even if it's $5,000 or $2,000, you can move it to your new employer if they have a qualified retirement plan, or you can move it into an IRA. I would recommend at Fidelity, the plans with Fidelity, it's easy to open an IRA at Fidelity if you are to leave employment with Selden, and then just move what balance you have into the IRA, and your money will still grow with compounding interest. Now, when it comes to some of the features to know, the IRS limits are out there, $23,500 if you're under 50, $7,500 if you're over 50. Fidelity has a ton of resources free to you at your disposal. Your company does have an employer match, does have a vesting schedule, and you do have Roth savings opportunity, which I'm going to cover here in the following pages. Now, this one is where it's extremely important and can have some pretty big implications on you when you retire. So you have two ways the money can be taken out of your paycheck: the traditional before tax. And the easiest way I can explain this, say you make, and I like easy math, say you make $50,000. You contribute $10,000 into the Selden 401k plan. To the IRS, when you report your taxes, you only earned $40,000. $10,000 of that came out before you paid taxes. Where that's great is it lowers your taxable income now. It can help you pay, or it can help you lower the income taxes that you owe. The money grows tax deferred, and you only pay taxes on the money when you take a distribution. So say under this scenario, you've been saving for 30 years, you have $500,000, you want to start drawing $30,000 a year out of your IRA. Most people, when they retire, they're going to move their money out of the 401k plan into an IRA. You don't have to, but just for general purposes here. So you start taking $30,000 of your distributions out of your IRA. At that time, you'll claim that $30,000 as income, and you'll pay taxes at whatever tax bracket $30,000 is in the future. Now, under the premise that when you retire, your earnings are going to be a lot less, and you'll pay less in taxes when you retire. Now, on the complete opposite side, you have Roth or after tax. Under the same scenario, you make $50,000, you contribute $10,000 into the 401k, you're going to report to the IRS that you made $50,000. There's no tax savings right now. But, and people would think, why would I want to do Roth? There's two key components. If you have had money in Roth for 5 years or longer, and you're 59 and a half, again, under the same scenario, If your money has grown to be $500,000 in Roth money, you could, when you retire, take the full $500,000 out and pay absolutely nothing in taxes. Pre-tax, you get the tax benefit now. Roth, you get the tax benefit later. One of the biggest questions I get asked is which one makes the most sense for me? I honestly can't answer that because everybody has a different situation, but I can tell you if you're younger, Roth should be something to consider because you have a very long time to save. You have a long time for the money to compound with interest, and there is a potential for a lot of money, a big pool of Roth money that you can take money out of and not have to pay taxes. Also, if you are on the high income end, you are restricted in contributing to a Roth IRA, but there are no adjusted gross income limits for contributing into Roth 401k. One other kind of simplistic way I tell people, if historically you get a refund when you file your taxes every year, you probably don't need a tax break right now. Roth is probably going to be a good option for you. If you typically owe taxes to the IRS, then traditional pre-tax probably is a good consideration for you because you want to lower how much you owe to the IRS. But one thing also keep in mind, you have the ability to split your money between both. So you could do 5% pre-tax, 5% Roth. It is an aggregate total of $23,500 per year that you can put in a combination of either pre-tax or Roth. But I personally think it's a great idea to do some pre-tax, some Roth. The reason being, I like getting a tax break right now, but also I like the idea that when I retire, I've had money in Roth for well over 5 years now. So say the air conditioner on my house goes out and then I have to spend $10,000 to replace it. I can take that money out of my Roth account and pay zero taxes on it, which is a great incentive for people to consider Roth. Okay, so a couple distribution options. When it comes to 401k plans, a lot of people don't like the idea that your money is quote unquote locked in until you retire. When you're able to take distributions, it's really at retirement, death, disability, separation of service. There are some options. If you are no longer employed, you can take a cash distribution and pay taxes on it. You would pay a penalty if you're under 59 and a half. You can roll it to an IRA or another qualified plan. And then there is also the ability for loans within the plan. So your money is not completely locked in, but it is somewhat restricted because it is under qualified tax status. The government does not want you to treat it like a bank account. Now, the biggest problem that people have when it comes to investing, and 95% of all participants in a retirement plan answer the same way when asked, do you consider yourself to be well-versed when it comes to investments? 95% of all participants consider themselves to be not very knowledgeable when it comes to investing. And their biggest fear when saving for retirement is making a bad decision and choosing your own investments. Now, there are a couple of ways to ease that, and you do have several options at your disposal. This says only 2 ways to diversify. It doesn't take into consideration something that Fidelity offers, but I'll cover that here a little bit later. But one is you do have a very well-diversified mix of investments inside the 401k plan. You have stock mutual funds, you have bond mutual funds, and there's also essentially what's a money market account. So you have the ability to pick and choose the investments that you want. Typically, by doing that, you can achieve a higher rate of return. But the problem is, from a statistical standpoint, the earlier you are, say you're 25 years old, you should and want to be very aggressive. You want to earn as much money as possible. Doesn't matter if the stock market's down 1 year. Keep in mind that every 9 out of 10 years, the stock market is up. And even at 2022, when the stock market was down 30%, it was up 35 the next year. Last year, again, almost 30%. So even though it hurts to see your money go down when the stock market loses money, you are, barring any unforeseen disasters, you are going to make money in the stock market in many more years than you will lose money. So if you do it yourself, you should have about starting 80 to 90% stock mutual funds and about 10 to 15% bonds and cash. As you get older, you should start to de-risk how much risk you take. For instance, me being 50 years old, if I didn't do this for a living, I should be about 60% stocks, 40% bonds and cash, because theoretically and realistically, I've had 25 years I've been saving. I've earned some pretty good rates of return over the past 25 years. I want to still continue to be able to participate when the market's up, but I don't want to risk it all. I want to be able to be a little bit more cautious, which is why I do hold bond mutual funds and money market in my own personal 401k, because in years like 2022, I want to protect what I've earned a little bit. And then by the time you reach retirement at age 65, you should be about 30% stocks, 70% bonds and cash. The reason that we still recommend having about 30% in stocks is you do want some appreciation to offset the money that you're taking out when you retire. So it's very difficult, and it can be time consuming for the average participant to go in every year, every 2 years, every 3 years, look at your investments, switch those around. It's something that a lot of people are intimidated by. Because of that, many years ago, the industry came out with what's called a target date mutual fund. These are diversified investments that are invested in stocks, bonds, and cash, and they do exactly what I described earlier. So they go out to about age 2065. That's for somebody who is just starting out their career and will retire approximately the year 2065 or 40 years from now. The way that works is it's about 85% stocks, 15% bonds and cash. And every 3 to 5 years, Vanguard, who is the target date fund family in your 401k plan, they automatically diversify the investments to become less aggressive every 3 to 5 years. There's no cost to you for them to do that. It's professionally managed by a team of portfolio managers, and it's a one and done. You start out aggressive and you become more conservative as you get older. That being said, you don't have to go into a target date fund that's based on the estimated year of your retirement. You may have money from another source. You may be 25 years old, but you may have inherited $200,000 from a family member. If that's the case, you probably don't need to take as much risk as somebody who's 25 years old, who's starting out with no inheritance, no retirement savings. If you like the idea of a ready-made mutual fund that automatically becomes more conservative, you could go to a 2035, a 2030, 2025. They're still professionally managed. They're still diverse, and they still automatically get more conservative. But maybe you just don't want to take as much risk as somebody 25 years old with no savings. On the opposite side, maybe you're one of those who's starting out later in life. Say you're like me, if you're 50 and you haven't started saving for retirement for whatever reason, and I know there are a lot of reasons out there that exist why people have challenges sometimes, so you want to take more risk. You could be my age. I should theoretically be in a 2040 fund, but I could be in a 2065 if I wanted to take on more risk. Now, one thing this page does not show, because we have to be somewhat generic, not all record keepers offer this. Your plan is through Fidelity Investments. Fidelity is the nation's largest record keeper for retirement plans. They are somewhat unique, where you have the ability to call Fidelity up and you will go to their standard participant call center. If you were to tell them that you want to get advice on your 401k plan, this is custom advice. They will transfer you to a team of licensed representatives who hold a Series 65, such as myself, and they'll ask you questions, and the advice that they give you is going to be as good as the information you're willing to provide. The more information, the better the guidance, or the better the advice. and they will give you a direct recommendation on A, how much should you be saving for retirement? And then B, how should your money be invested? They will give you a direct recommendation of saying you should have 20% in mutual fund A, 15% in mutual fund B, et cetera. And if you like that advice, they will hit basically enter. That will be your future allocation. And you have the ability to call them and get advice as often as you want. There's no cost, there's no obligation. They're not going to try to sell you anything. And this is truly a service that is out there for participants in 401k plans that are with Fidelity. Now, I say you can use it as often as you want, but just like a target date fund, if you were to call Fidelity to get advice today, and then you were to call Fidelity to get advice next year, their advice is probably going to be pretty close to the same because your investment strategy really doesn't need to change that much, but once every, say, 3 to 5 years. But keep in mind, it's out there for you and it's completely free to use. Now, as I mentioned before, the target date funds that are out there, the vast majority of participants in 401k plans, and statistically, it's almost about 80% of employees who are starting in a 401k plan are ongoing in a 401k plan, use a target date fund. One of the reasons being is that they're extremely low cost. They're professionally managed and they have really good rates of return. It takes the risk out of it for you for the most part, and it takes the worry out of having to choose how your money is invested. As I mentioned before, you have the different target date vintages. Some actually go out to 2070 now. But again, 2060, this is for somebody who's very young. This starts out very aggressive. And then in 5-year increments, it becomes less aggressive to when it goes into the income fund. This is for somebody who is already in retirement. It's a very conservative investment that sole purpose is to protect the money that you've earned through retirement. Target date funds, again, as I mentioned before, they start out mostly stocks, with some bonds, and then the allocation, or what we call the glide path, or the risk, becomes much more conservative the closer you get to retirement. Now, when it comes to your strategy, there are a couple setbacks to avoid. One, not regularly checking your accounts. My company puts that on there. I have no issue with people checking their accounts. People like to see rates of return. What the problem with that is that if you check your account and the stock market's down a little bit, and then that makes you nervous and get out. The reason why this is one of the worst things a participant can do, and I jokingly say I've been in this a very long time. I've been around in the industry since the dot-com burst of 2001. I've been around since the great financial crisis of 07 and 08 when the market lost 50%. And I saw this far too often. People don't take action until they get really scared, and that's just human nature. So back in 2007, 2008, on average, people didn't get out of the stock market until they saw a loss of around 20% in their account. So at that point, they've already locked in a 20% loss. People typically don't get back into the market until they're up about 10 to 15%. At that point, you've locked in a 20% loss and you've lost out on about a 15% gain. So right there, you've almost locked in a 40% loss and loss of gains in your account. Whereas somebody, it's hard to do, I admit it, even for me and people in my industry. People in 07 and 08, even if you lost 50% and you did nothing, when the market rebounded, within a year, you were made whole. Within the second year, you doubled your account. Somebody who moved out of the market, they would have been made whole in about 2 years. But would you rather be made whole or would you rather double your account? Most people would rather double their account. Again, nothing is ever certain, but even in the Great Depression, the market did come back. It's very unlikely you're ever going to lose 100% of your account balance. It's almost statistically impossible. So even though I know it hurts to see negative earnings in your account, don't let that bother you because the market does and will come back. Not taking into account retirement accounts from previous employers, That's one of the biggest problems we see often is participants will work for a company. On average, 5 to 7 years, I think, is now the statistical norm. They'll leave, they'll go to another employer. If you had a 401k account at Selden, as long as you have at least $7,000 in there, you're allowed to leave the money in by law. Now, say you go to work for another company for 7 years, you have $20,000. So you have $20,000 at Selden, $20,000 at your new company. Selden, as we recommend, does check the fees at Fidelity every 3 to 5 years. There's no contractual obligation to stay at Fidelity. If Fidelity no longer is meeting the requirements of Selden as participants, then we would work with Selden to find a new record keeper outside of Fidelity. If you're still a participant, your money goes over to the new account, you know exactly what's happening. The issue that we see, though, is when people change jobs, if they move, they're going to update their address with their current employer, but they're probably not going to update their address with their previous employer. They may not even think about their previous 401k plan, and they're not going to update the address there either. So under the hypothetical example, you've worked for Selden for several years, you have $20,000, you go work for another company, you move, Selden decides to move the 401k plan away from Fidelity to another record keeper. The money's still yours, but if you call Fidelity, they're not going to have your money. They're not going to be able to tell you where your money went. You're not going to get the notifications of where your account went to because you didn't change your address. Some people are very neat and they will change every address. But one of those things where, same with checking your beneficiary when it comes to all of your accounts and making sure those are up to date, it just makes sense for most people to consolidate their accounts if they change jobs or move it to an IRA. There's a lot of different strategies out there, but just keep in mind, don't stress about it. Even if you forget about a previous employer's account, the money's still there and it's still yours. It's just going to take a little more effort to try to track down where it went if it's no longer with the same record keeper. And then a couple other things, and I'm opening up to questions. And I will forward this out to everybody. Gallagher hosts a webinar. We used to do it once a month. These are free to all participants. And these are on topics that we like to piggyback on topics that Fidelity is great in talking about 401k plan and investing. What we want to do is offer topics that are maybe complement what Fidelity offers, but maybe be a little bit different and help you understand some basics. So for instance, last year, basic budgeting and money management. One that we had the highest amount of participation is one that was in March, prioritizing your debt goals, what debt to pay off first. If you have a mortgage, a car note, credit card debt, student loan debt, we all hear, if you make extra payments, you can pay it off faster, but which one should I pay off the fastest? What we've done with these, and not to scare anybody, we have 3 years worth of these, and all you have to do is scan the QR code on any of these flyers. You can pre-register for any of the upcoming ones throughout the year that are of interest to you. And you can also go back and watch any that we've done over the previous 3 years. These are hosted by practicing consultants such as myself, many of us who have done many years of employee education meetings. We usually have 2 to 3 consultants who are experts in this specific topic. So it may not be a retirement person. It could be somebody from our health and benefits side, if it's talking about your employee benefits, open enrollment discussions, which is back in September of last year, et cetera. And we try to make it in as plain English as possible. We know there's a lot of industry buzz terms and just different topics that can be a little bit confusing. We do many rehearsals of this back and forth to make it as easy to understand as possible. So the ones that are coming up for 2025, we were doing them once a month, but we're not doing them quite as often. But we have personal finance, financial planning, retirement account basics. For those of you approaching retirement, investing 101, one that we'll probably always have, open enrollment. That's oftentimes one that gets a lot of confusion from participants, just because on the medical side, things change often, even though Gallagher, I don't believe, is your health and benefits provider. It's still general conversations on considerations for open enrollment. And then one, because we had so much consideration on our interest on last year is avoiding and managing debt, and how to pay off that debt. So again, these are free to everybody on this call. There's no catch. There's no, we're not trying to sell you anything because we don't sell a product. We started these back in 2000 during COVID when the world went into COVID lockdown. I personally, in 2019, I think I had 60 trips to clients across the nation. So that was 120 one-way flights. I was used to being at the airports like a lot of my peers. We went from traveling, once a week to once every other week at least, to not leaving our house. I still hate to think back to those times, but we wanted to find ways to still impact our clients and our clients' participants. So we started these. We've gotten a lot of accolades over the years. So again, I will forward the 2025 out after this call. And again, by scanning that QR code, it will allow you to pre-register for any of those coming up in the future for this year, but it will also allow you to go back and look at any of the previous years that we have done. So with that, I am going to stop sharing my screen and open it up to questions. And it might be easier if the questions are typed, I'm not sure, but we can try either way.
Kurt, we were asked about clarifying what is younger when you were speaking about the Roth IRA.
So really 35 and below, just because you have about 30 years to retirement. But even 40, I would consider, well, 30 would be my consideration for younger when it comes to Roth. I see one question. Can we set up a trust for our kids? And let me see. Can we set up a trust for our kids? Yes, a trust can be set up for kids. I can't really advise on trust because that goes out. I don't deal with trust in my side of the division, but there's a lot of information out there really available on trust. You can even fund an IRA for your children. Anybody can fund an IRA. Why is IRA a better option versus Roth after you retire? If Roth is, I believe, pre-tax, already pre-tax. So the reason that Roth is, in my opinion, better when you're retired, if you defer pre-tax, you pay tax on the money you take out. On Roth, since you've already paid taxes, once again, you can take out money from Roth and you don't pay any taxes on it at all. So I see one question: if you're in your 30s, would there be any benefit of splitting contributions? I honestly, I wish Roth had been out there 25 years ago when I started. I think it makes sense for most people to consider splitting their contributions between pre-tax and Roth, regardless of age. Now, that being said, unless you are, say, 55 or older, you've never contributed into Roth and you plan to, say, retire at 60, you have to meet those two requirements of 5 years and 59 and a half. As long as you meet those two requirements, the Roth money is tax-free. But if you don't meet both of those retirements, say you're 59 and a half, but the Roth has only been in there for 3 years, you still can't take it out tax-free until it's been in there 5 years. But unless you are in your final years towards retirement, splitting contributions between pre-tax and Roth makes sense, in my opinion, for the vast majority of people. But again, everybody's financial situation is different. If you typically owe a lot to the IRS when you file your taxes every year, Roth may not make that much sense now, only because you want to try to save as much as you can on taxes. But again, that is one that it's more of a generalization than anything, but I think both makes the best idea. And yes, you can transfer your account from your previous employer into the Selden 401k plan. You can call Fidelity. They have a rollover team that is available to you, and they will work with you to work with the record keeper from your previous employer and get that money into the Selden 401k plan. Question, can Roth contributions to Selden 401k that might not be at 5 years? So this is one of the kind of more interesting things. So if you split your contributions between pre-tax and Roth, say you have $50,000 pre-tax and $50,000 Roth. When you retire, you are going to have, assuming you move your money into an IRA. And I don't want to go too deep in the weeds here. 401k plans were set up to accumulate money. They're not the best at, when you retire, taking payments out. So what most people do is they'll move their money into an IRA and set up what's called substantially equal payments. That way you're not hit with a distribution fee every time. It saves you money. But under that scenario, if you have both sources of money, pre-tax and Roth, you would have to open up a regular IRA and a Roth IRA. Now, one thing that's also interesting, and I didn't cover, is in a 401k plan, if you're retired, starting at the age of 73, and this is the same in a 401k plan as an IRA, you are required to take out what's called required minimum distributions. The IRS wants you to take out money because they want to get taxes on that money. So if your money is pre-tax, there is a calculator on the IRS website, also on the Fidelity website, that will show you how much you're required to take every year. It's a percentage. It starts out small and it grows as you get older, because the IRS wants you to take the money out because you haven't paid taxes on it yet. They want their taxes. Now, when it comes to Roth, there is no required minimum distribution. That's also a big factor to consider. That's the same whether it be in the 401k plan or in an IRA. There is no required minimum distribution for Roth dollars. Let me backtrack, John. I'm not sure, can Roth contributions and settlements 401k that might not be 5 years be transferred to a personal IRA? That's only assuming that you're no longer employed with the company. So you can't transfer money out of the Selden 401k plan into an IRA if you're still employed unless you're 59 and a half. So I just want to make sure I clarified that. Any other questions, guys? I know we're getting close to time. I think so. Unfortunately, no. In the Selden 401k, you can only come out of deferring from your paycheck by the company. Now, if you opened up an IRA, you can contribute directly from your checking and savings account. One of the problems, though, is that if you're eligible to participate in a qualified retirement plan like a 401k plan through your employer, it limits your eligibility on what you can contribute into an IRA, just because the government wants you to, for a lot of different reasons, put your money into a qualified retirement plan as opposed to an IRA. There are some benefits to that. IRAs are not protected from creditors. So for instance, if you were to have to file bankruptcy for some reason, creditors can go after your IRA, but not your 401k plan. So there's a lot of protections offered inside the 401k plan that are not offered inside the IRA. So within the 401k plan, it is, and let me just double check limits for 2025, up to $23,500 if you're 50 or below. If you're over 50, it's an additional $7,000 catch up. Wendy, so yes, as long as the IRA contains qualified money, not, don't want to get too complicated with that. But yes, long story short, for most practical purposes, if you have an IRA, that can be moved into your 401k or at some point Roth. So Roth can only go into Roth. But that being said, if you have pre-tax money, and don't want to get too deep in the weeds here, you do have the money in an IRA to do what's called a Roth conversion. So say hypothetically you have $100,000 pre-tax in an IRA. If you wanted to convert that into Roth, when Roth first came out, you were given 5 years to pay taxes on that. Now you don't have that benefit from a taxation policy, but for all practical purposes, if you wanted to convert your IRA into Roth, whatever the amount you convert is, you would claim that as income for the year you do the conversion, and the 5-year clock starts at the date you do that Roth conversion. So say, hypothetically, you converted a pre-tax IRA into Roth on February 1st, 2025. The countdown for 5 years starts February 1st, 2025. So February 1st, 2030 is when that money will become pre-tax once you're age 59 and a half. So the max amount, no, the max amount, the 23,500 is employee deferrals. That does not include the employer match that you're eligible for. As I mentioned earlier, I will forward over to you guys that 2025 flyer for the upcoming presentations and webinars that we have for the remainder of this year. And again, you have 3 years worth of them to go back and review. They're available at your disposal at your free time. One of the reasons also, I kind of forgot to do this, we often realize that the person making the financial decisions may not be the person on the call. It could be a spouse, it could be a domestic partner, could be a family member. So you have the ability to also do those webinars at your free time. And I hope you guys have a great day. One last question. That is correct. So the year you convert a traditional IRA to Roth is the year you would pay taxes on it.